Thank you everyone for coming out to the real estate meetup. This is our second one of the month. We do have two every month on the second and fourth Thursday. My name is Tanner. Ryan is the other guy that usually hosts it with me. He is currently in Mexico right now. One of the benefits of being financially free, to travel wherever you want. And we host it. We are both real estate agents, investors, and house hackers ourselves. So if you have any questions about real estate, buying a property, doing anything unique, whether it's in a commercial space as well, we do have experience in those fields. And today we're going to have Jeremy Stebbins give a presentation about low money down loans, how you can kind of get started into real estate, do some house hacking, and what a lot of those benefits are. So give it up for Jeremy.
All right. Thanks, Tanner, for the intro. And yeah, like Tanner said, I'm Jeremy. I'm a loan officer with Guild Mortgage here in Colorado Springs. We're located off Kelly Johnson and Academy area. And yeah, I mean, excited to present on low down payments. I think it's a really important topic in real estate on how to build wealth and understand what those options are and how to leverage them. But, you know, before I get into that, I do just want to say thanks to Tanner and Ryan for hosting this group. I've been coming for a couple of years, and not only has it been a good place for me to network, but I feel like I've learned a ton. So I'm here to learn as well. And it's kind of been instrumental for us and our family as we've kind of decided to invest a little bit in real estate as well. But with that being said, I'll kind of jump into things. So if you can't tell from the pictures, you know, I'm not just a loan officer. I also run a nonprofit, otherwise known as my family. So I know most of us are here to think about how are we going to save money, how are we going to cash flow more, but if you want to talk about spending money, I can tell you about that because it's expensive having a family. But we do love it. Our lives are busy. Hannah's here with me tonight. This is my wife. We've been married 8 years. We have 3 little ones together. Something about Hannah is she's extremely extroverted, and so if you want to do me a favor and introduce yourself to her in a very loud and assertive manner after the presentation, she'll really love that. Okay, I'm just kidding. But you should still meet her though. She's great to meet. And yeah, so I guess to just talk a little bit about how I got into being a loan officer. Well, if you think about the timelines, I think you guys are going to kind of figure me out because I got into the business about 4 years ago. If you think about what was going on 4 years ago, rates were super low. And you know, here's a picture of me 4 years ago. Real estate has changed me. You can see my hair's shorter, was shorter then, now it's longer. But you can almost see like the calculation on my face of like, I'm going to need more money if I'm going to have a family. So that is part of it. I mean, that's part of the truth. That's why I got into real estate and got into lending. I don't think there's anything wrong with that. But if you think about what happened next, the industry kind of flipped upside down almost. And in 2022, rates, you know, jumped from 2%, like almost up to 7%, or, you know, and it was this big cataclysmic event in our industry, and a lot of loan officers left. And so for me, I think the question has more been, why have I stayed in the industry? Because, you know, when I got started, it was sort of a cash cow, and it was easy because rates were low, anybody could qualify, you know, a caveman could do a loan during that time. Then it got to be kind of a more scrappy business where you really had to hustle to find enough clients. You really had to work hard for clients to get them qualified. But the reason why I stayed is because, I mean, it's a cheesy answer, but I really do love it. It's really rewarding to help first-time home buyers or somebody buy their next property if it's a multi-investment plan, because, you know, in some cases you're kind of helping people make their dreams come true, or at least help them have a big win and a big success that's going to, you know, carry on further in their life. So I really love what I get to do. A little more about me. consistently I've been kind of in this top 70, 80% of LO production in El Paso County. Obviously, the more deals you do, the more experience you get. That certainly helps. A lot of my business has been VA and first-time home buyers over the last year. Like the vast majority have been more active in this market. And I don't really consider myself a salesperson. I really like to help people analyze things and think about what are all of the options and what's really best, and let's weigh and consider these different pieces and factors and kind of find the best possible plan. Just to tell you a little bit about Guild Mortgage before we kind of jump into the presentation. So Guild is a really cool company, very large. We're the 8th biggest mortgage company in the US. Because of that, we kind of have our hands in a lot of pots. And we are a direct lender, so that means that we do fund basically all of our loans in-house. That kind of gives us a more rigid infrastructure to troubleshoot or close loans quick. But the cool thing about Guild is that we also have the ability to kind of shop rates to an extent, so we can look for who's offering you the best conventional rate. Is it PennyMac or AmeriHome or VA? Is it New Res or PennyMac or something like that? So we do have the ability to shop some on your behalf, which is cool. This is a picture of me with our president, David Nayland, and he came and visited about 20 of us LOs in Denver. And to put it in perspective, this was a really cool move because Guild is about a 5,000-6,000 employee company, and he just kind of came and kicked it with us. We had appetizers and some cocktails, and I think I was like a couple of old fashions in, and I made multiple jokes about how I was going to be Guild's next president. And so I'm hoping that he forgot that, but he laughed. I think he laughed. I don't know. Okay. Just real quick. So I'm an investor myself. Hannah and I, we do manage one single family long-term rental here in town. We also have an Airbnb unit. Fun fact, it was really this group that really motivated me a couple years ago to really start thinking about real estate investing. And so I'm hoping that I can weave in some good knowledge to this group because it's definitely benefited us a lot. All right, so real quick, we're talking about low down payments today. And so just a quick history. So in 1938, Congress creates Fannie Mae, and Fannie Mae sort of allows for, maybe it's a little oversimplified, but helps America get out of the Great Depression to an extent via home ownership, making it easier for your average everyday person to buy a home. And slowly by the 50s, largely due to this, the middle class is kind of born to an extent because of this move. And if you guys don't understand kind of the way Fannie and Freddie work kind of in the grand scheme of U.S. mortgages, this is kind of a quick little breakdown, but banks and non-lenders like myself who originate loans, we sell to Fannie Mae, who keeps some of the risk, but then sells the loans to investors. So I think the thing that's lost oftentimes is Fannie and Freddie actually maintain the risk even though they sell to the investors. So it's a pretty sweet deal for investors who get to buy back, mortgage-backed securities that have less risks than they normally would because Fannie and Freddie maintain that. So as much as we like to complain about strict underwriting and rates being high, honestly, none of us would have nearly as good of a rate as we have if it weren't for Fannie and Freddie and their process in this. So just so you understand that. Okay, so 20% lending eventually gives way to lower down payments. So as early as 1956, PMI gets introduced. Can somebody, this is an educated group, somebody tell me what PMI is? That's right, yeah, so it's an insurance policy you pay for your own risk because you're not bringing 20% down on the loan. So the bank makes you pay that in order for them to lend you money to keep your risk where it's supposed to be. If you think about it, before that, the lender's only insurance policy was you bringing 20%. Otherwise, you didn't. The bank could lose money on the deal if you default. So eventually, by the 70s, the 5% down conventional mortgage comes around, and eventually after that, we would see 3.5% down FHA, 3% down conventional. So where does that leave us? It kind of in 2024, it's kind of turned into an explosion of different options. And I do think that, this topic, if you can focus on it for a minute, if you're thinking about buying another primary, if you're able to evaluate these programs and kind of understand, there's potential for you to save thousands or at least help you pick the best strategy that will help you save thousands in the long run. So low down payment programs. By the way, on PowerPoint, I picked this icon and I kept typing in like help or assist, and it kept giving me this icon. Does anybody know what this is? It's like
It's crack.
Crack, yeah. Okay. That's kind of what I thought. It's a questionable potion. I don't know why. I didn't type crack into the PowerPoint. This is what it came up with. So real quick, so we've got 3.5% down FHA, 3 to 5% down conventional mortgages, obviously 0% down VA, 0% down USDA, down payment assistance programs. And now what we're seeing a little bit more of are these special lender offers of 0 to 1% down. And we're going to break those down a little bit as well. I'm just going to say this now. I don't know every last low down payment program that's ever been created. We're just going to go over the ones that I know about. Okay. Real quick. So 3.5% down FHA. Some pros and cons. More flexible underwriting. Does allow for 2 units. Mortgage insurance is a fixed rate, which is kind of a neutral point. If you are higher risk, that fixed rate sort of helps you. If you're lower risk, that fixed rate sort of hurts you. Mortgage insurance is for the life of the loan if it's a low down payment, so that's a downside. 3% down conventional. One of the highlights is there are subsidized programs that offer even lower rates if you have a lower income. So if your income is under 80% of the area media income, you can get kind of even additionally subsidized rates with home ready programs and home possible programs. So those are good to keep an eye out for. They are going to be 1 unit only for 3% down. Mortgage insurance can be high and no co-signers when the down payment is this low. 5% down. So mortgage insurance improves per month. And the big thing here is now you can do 1 to 4 units. So that's news that came out about 1.5 years ago that you can do a 5% down on a 4-unit property. So that's a big improvement from the minimum, which was 25% down. And it's not really a con, but just like this is a borderline not low down payment, because for an average median home in Colorado Springs, you're going to need about $30K, and compared to some of the other programs, that's a little bit higher. VA loans are awesome. There are tons of benefits, and the only downside is accessibility. You have to have that military entitlement, or else you can't do it. But better rates, no mortgage insurance, more flexible qualifying parameters. They're not so much cosigner friendly, and we can have more appraisal issues with them. USDA loans. A lot of times we get calls, people are excited when they hear about USDA loans because they see 0% down, they see no mortgage insurance, but they haven't understood yet that you can only use these loans like way outside of city limits. And so usually we get a lot of inquiries about that, and they usually don't really go anywhere, to be honest. It also has income limits as well as more difficult underwriting procedure. Down payment assistance. So this is kind of some of the lower cash to close options you're really going to find. A lot of us are familiar with CHAFA here in Colorado Springs, but there are other programs as well. CHAFA tends to be the easiest to work with, as well as offer the most sensible terms. So I think a lot of lenders stick with CHAFA. Low barrier to entry. You just have to take an online class. You don't even have to be a first-time home buyer. Anybody can do it. Rates are fair. You know, they're not going to be like the lowest rates available, but for what they are, they're pretty reasonable, and payments stay pretty reasonable. Obviously, it's increased leverage on the property. Like, you would have LTV that's greater than 100, and so that is a certain level of risk. If you needed to refi fast or sell the property fast, you're going to have some limited options. Higher fees certainly are a downside to down payment assistance. Okay, now we're getting into those kind of special lender offers. Have you guys seen these online or on social media where you see something like 0% down? Maybe it's just me because I'm a lender, so the algorithm, knows this is what I'm thinking about all the time. So these are essentially kind of FHA programs in disguise. If you think about, ultimately these loans have to be sold, so they must meet the conforming parameters. So these loans are essentially FHA, in disguise, if you will. And they do allow for 1 to 2 units. They bring cash to close way down, which can be appealing. But higher rate, second mortgage that may need to be paid back, additional guidelines, restrictions might apply. Bottom line, read the fine print. But, like if you take a median home in Colorado Springs, one of these programs could maybe save you $19,000 up front. But you do pay for that later in the mortgage payment being higher. So these 1% lender offers, these have kind of come around. These are essentially 3% down conventional mortgages in disguise, because again, it has to be conforming, but it's a bit of marketing to make it sound a little better than it actually is. And they are actually a little misleading, because most likely it's a grant that's limited to 4 or 5K per transaction. So if you think about what a average home is in Colorado Springs, that's probably not 2% of a mortgage. But just because it's misleading doesn't mean it isn't maybe worth considering, because that's again $4,000 or $5,000 kind of being thrown to you at closing. And I think this is partly what's happened to the industry. Banks and mortgage lenders are a little more desperate, so they're kind of like throwing money out there, making special promotions, and what they're hoping is that maybe they'll lose a little money or make very little money on the initial transaction, but then they can maybe make up for it with a refinance later. But still something for you to potentially take advantage of. Still might be worth doing, even if there is sort of a greedy underbelly to it. Yeah.
You put a term in there that non-conforming. I heard of those.
Conforming just means Fannie and Freddie buy it, essentially. Yeah. So, yeah, these, Fannie and Freddie would never truly buy a 1% down loan, because that wouldn't be conforming. It would need to be at least 3% down. But essentially, this will be a 3% down when it's all said and done. It's just kind of they're able to market it as a 1% down, if that makes sense. Okay. All right. There might be income limits. That is a downside. But a pretty big plus that there's not a second mortgage. You get help at closing, but there's no second mortgage to deal with later. And yeah, I mean, these might be seriously worth considering, and I kind of talk a little bit more about this, okay, on the next slide. If you were confused before, now I'm going to confuse everyone for sure. My wife gave me feedback to not try to explain everything that I did here, so I won't. But essentially, I came up with a scoring system for these programs because I think it's fun because I'm a loan officer. So basically, I'm awarding points for certain characteristics. I'm not going to explain how I did it, but you get more points for lower cash to close. You get more points for lower payments. You're awarded more points for a grant as opposed to a second. You kind of lose points. So kind of just taking the various pros and cons and scoring them. And so what might be interesting to look at is the estimated cash to close. This is based on a 400K home in Colorado Springs. And if you look, these are some pretty low numbers to close on a home like that. And that's not even including seller concessions or anything like that. We'll get to that in a minute. But nothing really beats the VA, but the 1% down really kind of scores well across the board. The CHAFA second programs really score well because their payments are pretty reasonable and cash to close is pretty low. FHA does fine, and conventional loans, they don't rank super high here because their cash to close is higher than the rest. That doesn't mean they're truly inferior programs. It just means that in my little point system, they're not scoring as much that favors lower cash to close. But let's not forget that your average mortgage lasts 7 years. And so I think this is something that, sure it's a 30-year mortgage that lasts for 30 years, but the average life of a 30-year mortgage is about 7 years because life happens, you move, you sell the property. So it's really important to think about that. And so what I did here is I kind of added in a total 7-year cost for all these programs. I rolled over the points from my crazy spreadsheet over here. And then kind of, finally ranked these as just, and maybe this helps you on how you can think about these programs and what the pros and cons are. I don't expect you to remember my arbitrary rankings, but yeah, the 1% down conventional program really kind of sticks out to me as maybe a little bit of an underrated, unknown option. But Jaffa really does well. FHA conventional do well. The 0% down FHA, it does lose a lot of points because it's going to be the most expensive in 7 years. However, keep in mind, it's the only option on this whole board that allows for down payment assistance on a 2-unit property. So even though it's scoring the worst, there might be a time and place for this program, certainly in some cases. Does anybody have any questions on this? I mean, you get kind of what I'm trying to do here?
So you're saying join
Yes. Yeah. I hope it's helpful. I'm realizing I'm nerding out a little bit, but hopefully it's helpful.
These go owner-occupied only?
Yeah, these are owner-occupied only. Yeah. We can talk a little bit about non-owner occupied, but this is kind of more catered to. So house hacking, yeah.
So that would include a duplex?
Yeah.
Is that considered 1 unit?
So long as it's 2, yeah, okay, yeah. If it's 2 units of any kind, it's considered a 2-unit property. So it gets a little weird. A property could classify as single family, but it's 2 single families on 1 parcel. So it could be a true duplex where it's 1 structure, 2 units. But a lot of these house and cottages that are 2 different structures, ultimately they're going to be appraised as 2-unit properties. Even if the house is a mansion and the cottage is tiny, it doesn't matter. They're essentially both, single family units on 1 parcel. So from a lending standpoint, regardless of zoning or whatever, Fannie and Freddie look at that as a 2-unit.
So something like with an ADU on the back, or something like you see over in Colorado,
Mhm.
Colorado City, where you have a garage with
Mhm.
a unit built on that. That's what you're describing?
I would say 60-40. My guess would be most of those would ultimately classify as 2 units as opposed to 1. But, you know, a small ADU on top of a detached garage, I could see that maybe classifying as a 1. But yeah, the appraiser, yeah, essentially, they're kind of the boots on the ground for the bank. You know, they want to make sure that the bank knows exactly the nature of the property they're investing on. And it does get, with 2 units, it does get pretty gray pretty fast. Things like if both structures have meters, you know, that if they both have separate addresses and mailing addresses. But even then, I found that more times than not, they're going to, if it even slightly resembles a 2 unit, they're going to lean that way. That's kind of been my experience. Yeah.
The other opportunities that we have out here that
Mm-hmm.
allow you to put, or actually go, you get a 35 plus acre
Mm-hmm.
ag, but from the ag, put a second
Yeah.
structure on that. With that kind of scenario would be considered.
Yeah. So you could almost buy that as a single family, but then when you build it, if you ever to refinance, you know, the appraisal, they would probably determine that it was converted to a 2 unit. And so those lending standards would apply then at that time. Is that
No, that helps because
Yeah.
I myself am looking at some parcels that are over 35 acres.
okay?
And if it's some ag,
Mm-hmm.
then I know I can put another unit
Yeah.
on it. And if it's zoned RR5, then I know I can break those into, if I get like 35 acres plus,
Mm-hmm.
break it into 5 acre parcels, or do I just build, not break it, but build a second on that 35 acre land?
Mm.
In R5.
I'd probably call the county. I don't know.
That's,
Yeah.
I mean, but that's really interesting, the 2 unit thing,
Yeah.
because it's also becoming pretty prominent down in Colorado City.
Yeah. There's a lot. Yeah.
And new laws change. ADU accessibility doesn't apply to lending, it applies to Colorado, as far as the ADU approval process. Approval that figured out with the new law that passed goes into effect first part next year. Make it harder or easier to put an ADU in, following California.
Yeah.
Don't grow too badly. I hope we don't do that. Well, but yeah, it happens.
So basically, you're saying you love California, essentially. No, I'm just kidding.
The lending part, the zoning,
Yeah.
legislative part, the whole separate conversation.
Yeah. No, I catch what you're saying. Just to keep things moving. So just, you know, at this point, a lot of us are probably familiar with seller concessions and how, you know, pivotal a role they can play in this market. You know, just to kind of touch on this sort of quickly here, but it's a pretty important piece to the pie, I think. So there are limits when it comes to mortgages of how many seller concessions you can get. Conventional, generally 3 to 6 for primary residence, depending on the size of the down payment. Investment properties strictly limited to 2%, FHA up to 6%, VA 4%, and these are all of purchase price. Jumbo loans probably 6%, but you have to check with the lender since it's its own agency. Non-QM likely 3 to 6% for those types of loans, but you would need to check with that lender. Examples of how you can spend seller concessions when using a mortgage: cover all eligible prepaids, closing costs, closing fees, can cover points to buy down the rate, can be used to cover a temporary buy down. VA only can be used to cover the borrower or buyer's debts at closing. So if you have like a credit card balance for $4,000. The seller can pay that off for you, which is kind of interesting. And maybe pay for additional items of value, such as like a home warranty or upfront mortgage insurance premium. So one just little exercise here, and this is maybe a bit limited in scope, but kind of communicates a point about this market. So I've got a scenario here of a $400,000 purchase in Colorado Springs. One bought in 2022, the other bought today. And the only differences here are today you're much more likely to get 10K in seller concessions than you were in 2022. I think most of the agents would agree with that. The rate, you have to keep in mind, okay, September 2022, rates were kind of on the rise at that point. We've seen rates come down now, so rates are close. But if you were to extrapolate both of this out over over 7 years, it's actually like when you look at total costs, closing costs, down payment, and mortgages for 7 years, which is 84 months of mortgage payments, it's actually cheaper to buy a property today with a higher rate than over 7 years than it would be to buy a property 2 years ago where closing costs were not covered. So just something interesting to think about, that this market provides more benefit that we can maybe actually realize, as opposed to in 2022, yeah, the rates were really good, but if the average mortgage only lasts 7 years, are we really going to realize those gains and benefits over a 30-year period? So seller concessions, how should you spend them? Well, you should probably always first spend them on closing costs, because that's an immediate financial gain that now less money has to leave your bank account to close. So you should probably always do that first, but then you could think about buying the rate down permanently or doing some kind of temporary buy down, or both. So I would kind of lean strongly toward temporary buy downs personally, because there's no financial risk that if you were to refinance, you get to keep that money in a subsidy account that would then get applied to your refinance later. So it's a guaranteed dollar for dollar return. Whereas permanent points are always a little bit of a gamble. If you spend a bunch of money to buy the rates down, but then rates drop, you kind of wasted however many $1,000s on buying that rate down at the time. So, but permanent points are a by far more powerful tool over 15 to 30 years if the mortgage lasts that long. Okay, so here are some low down payment success stories in 2024. This one is a 2-unit property that we used a 0% down style FHA. So for a $542,000 2-unit, pretty valuable property, we were able to close for as little as $11,000. The buyer moved into the cottage, and he's renting out the main house, Airbnb, and that's doing well. These next 3 here, these are all Chaffa primary residences, where we were able to use Chaffa and seller concessions to dramatically lower the cash to close. And if you think about this, these 3 right here, I mean, these are borderline lower out of pocket than, first month's rent and a security deposit, and they get to keep the house. So that's a pretty cool opportunity that exists in this market. This guy over here with the concrete, he used a Chaffa conventional. That saved him, $12K up front, and he used that to convert his basement, and now he's renting that out Airbnb. And then this one here was a VA loan, 0% down, and it was a couple of soldiers who house hacked and they rented out all the other rooms. So pretty cool stuff. 6 properties, $2 million funded for, a cumulative of $27K out of pocket. So that's my last slide, but I guess as kind of a closing remark and just something to think about, a couple of years ago, we thought of real estate as sort of a gold rush because interest rates were so low. But, if you kind of think about what's happening in this market, and there's so much opportunity with so many listings out there. I mean, Tanner, aren't listings way up right now?
Yeah.
So you got a lot of sellers. Average days on market 37 days, something like that. So you've got all these sellers who are pretty eager to sell their home, and they're, asking for 5, 10K in concessions. Those are gains you can actually realize, even if the mortgage is only going to last 5 to 7 years. And so, arguably, this market, even though rates are higher, there's perhaps in some situations there's more financial gains for us to kind of go out there and get, and especially utilizing low down payment programs. But yeah, so if you have questions or you want to get pre-approved, and we can talk questions here after this. Also, I'm an author now. I'm just kidding. I'm almost done with kind of this little ebook thing. It's going to be for first-time home buyers and renters. And so going to be a great resource if you're an agent, if you're an investor, if you're a renter, to kind of get more of a feel for how the mortgage process works. But that's all I've got. Any questions that we haven't talked about yet?
Do you have any non-recourse loans?
Not at Guild. Yeah. You might, I know in the non-QM world, the closest you'll get to that is they may allow you to sign a loan in an LLC, but they may also require that you co-sign with the LLC. So it's not really a non-recourse loan because you're still on the loan. So
Well, if you buy from the IRA or something.
yeah,
There's some questions about getting loans from the IRA.
that's pretty specialized. You might find that in the non-QM world, but I've kind of gone down that road and it is pretty tough to find. Not that it doesn't exist, but it's tough to find. So that's like so QM is qualified mortgage and or conforming mortgage. That means a Fannie Freddie. Non-QM is kind of any other bank in America that's investing. They may do bank statement loans or non-recourse loans or other types of lending. DSCRs, exactly, yeah. That's what I mean by non-QM. Yeah. And we do those as well, but not so much the non-recourse.
Jeremy, use your example of the slide about what it cost in 2022 and what it costs today.
Yeah.
Do you count the increase in insurance and taxes?
No, this is just a look at principal interest and cash to close and down payment. So it's, I guess, a little oversimplified. I didn't go too deep on that. Yeah. But, yes, insurance has gone up, but because real estate was so hot in 22, you might get this home for a little bit less in 2024. And so that could maybe offset that. Not that we've maybe seen true depreciation. That's debatable, but 2022 is so hot that, this house might actually be a little bit cheaper in 24.
Yeah, just the reality that
Yeah.
the taxes and insurance was increased dramatically.
Yeah.
It's something to consider. You're now.
Yeah. No, that's true. Yeah, there's more I could do with that, and I agree.
I mean, maintenance, everything costs.
Yeah. And I do those. I do get into that in my shameless plug, my ebook for renters and first-time home buyers. But I did not get too deep in that in this. So that's a fair observation for sure.
Just personal experience.
Yeah.
Real.
I don't like it either. Yeah, it's tough.
You talking about here in Colorado?
I just don't have it. I still tell Jeremy.
Don't tell me what. Nothing. Mortgage fraud?
No, I'm saying I don't get.
Bad. Mortgage fraud, bad.
I don't need insurance.
Oh.
All right,
Yeah.
give it up for Jeremy. Woo! All right, guys, thanks for coming out. We do have about 40 more minutes for networking if you want to stick around and meet someone that you haven't met before. The meetups are best for networking. It's great to learn something new, but meeting what other people are doing in your local market is probably the best way to move forward in your real estate journey.